the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market closed for the day, the biggest movers, and of course the sectors and companies to watch. But as always, here's a quick recap of some key movements. Singapore shares rose as all eyes remained on the global trade situation. So the Straits Times Index was up 0.34% at 3,884 points at about 11:46 a.m. Singapore time, with a value turnover of some 639 million Sing dollars in the broader market. Now let's take you through the closing numbers. As we shared with you earlier, the STI ended in the green, up 0.54% at 3,891 points. In terms of value turnover, we're looking at 1.52 billion Sing dollars. Gainers trailed losers, though, 238 versus 283. Top advances for today, we've got for you DBS, HBL and UOB, and top decliners we've got GMHUSD, Jardine Cycle and Carriage, as well as Shangri-La Hong Kong dollars. Now, in terms of companies to watch, we have Genting Singapore, because the company said its CEO Tan Hee Teck will step down, and the firm also announced its financial results for the first quarter ended March yesterday. Now, meanwhile, from SingPost shares plunging nearly 12% this morning on the back of its result release, to Starbucks reportedly kicking off its process to sell stake in its China business. We've got more corporate and international headlines in focus. And joining me today is David Chow, Director at Azure Capital. David, welcome.
Hi, Tan Tian. Hi, everyone. Happy Thursday.
Happy Thursday. And David, let's start with the Singapore stock market as usual. How did the STI fare today, especially against regional peers? Because Asian markets mostly lower. News that Beijing was suspending some non-tariff countermeasures on U.S. entities for 90 days also failed to excite markets. But your sense on the STI movements in relation to the region, really?
Right. I think, since the opening bell at 9 a.m. today, STI has had mostly traded lower, but it turned tight in the second half of the day and, ended up the day 0.5% higher. And if I measure against the regional market, maybe I can use indices like the MSCI, APEX 50. So this index, actually was flattish. So, with a 0.5% higher closing today, STI effectively, outperforms the regional markets by about 0.5%. So if you take a step back, I think it's fairly normal to see a bit of rates coming in, as the global markets, have been up for the past several sessions. So market is doing, what it usually does in this case, which is to take a breather. The current, China and US, the escalations has not been largely priced in, and I think the market is probably waiting for more news on this front, before determining, which direction does it want the markets to go.
And David, I do want to take a look at some companies to watch for today. On our list is Genting Singapore, because Genting Singapore said its CEO Tan Hee Teck will step down, and it also yesterday announced its financial results for the first quarter ended March, where if we look at net profit after taxation, it tumbled 41% to 145 million Sing dollars from some 247 million Sing dollars seen the year before. How would you read into the two developments in totality?
Right. Firstly, on the financial numbers, first quarter 25 core net profit was down 41% year on year. But I think this is still within the market's expectation. In fact, based on the tracking that we have done, share prices, has been trending lower since September last year. After the F1 event, which I think saw a record crowd of about 270K, and this news flow really propelled sentiment, for hospitality and tourism-related stocks last year. And but after September 25, when you see the tourism numbers and we see some of the business updates by Genting and its RWS competitor, we can see that the numbers have been trending down, and this has probably fueled expectations for markets to continue to sell down on Genting. And specifically for the first quarter, we've seen a slowdown in VIP volume actually falling by 19% year on year, even as the first Q mass gaming volume volume revenue increased by 3.1% year on year. So in first Q of 24, the VIP actually recorded a high of 10.7 billion of gaming volume as compared to only 8.7 billion this year. And VIP volume is really the key here for any casino operators. So as a result, this actually caused revenue from the gaming side to decrease by 20% year on year, and even the non-gaming side was down 9.5% year on year. So with a top line that has been coming down, it's not difficult to see the bottom line coming down as well. So going into maybe the second and third Q, we do expect operations to be seasonally lower, post Chinese New Year in the first Q. And I think after talking to management, we do get the feel that this trade war between the US and China really had an impact on VIP volumes, possibly going to the second Q. So hopefully in third Q, we expect operations to be stronger.
And another company to watch for the day, David, is ComfortDelGro, because the transport behemoth posted this 19% rise in net profit to 48.3 million Sing dollars for the first quarter ended March, of course on contributions from last year's acquisitions and improved margins. And what is also interesting is how the main board listed firm said it was confident that its cabbies would not jump ship to Grab. Any thoughts on that, and what's your take on the near-term outlook for CDG?
Right. With regards to the financial numbers, I think when I'm looking at the financial numbers, I noted that the operating profit across segments in Singapore have vastly improved, due to cost control and internal efficiency gains. Net profit, however, was affected by higher net interest expenses arising from increased borrowings to really finance the acquisitions they have made overseas last year. So the first Q net profit after tax figure is about 20% of our full year earnings forecast thus far. So far so good. And I think some of the other highlights are that the first Q public transport revenue have also grew 2.6% year on year. As the UK Metro Line Manchester contract started in Jan 25 actually kicked in, and we also see that SBS Transit has submitted its bid for the PT220 Tampines bus tender, which will be commencing next year. So and then on the confidence of ComfortDelGro that the cabbies are not jumping ships. Well, earlier this afternoon, I was in a Grab vehicle, traveling from the UOI building in Robinson Road to Marina One, and he was complaining that the fares was so low. He was only getting $5 for a mere 20 minutes for a near 20 minutes distance. So this tells you something. And from the results of ComfortDelGro, you can see that this taxi and private hire revenue, they actually surged by 74% year on year to about Sing dollar 250 mils. And but even so, the EBIT margin from this segment actually narrowed to about 13.6%. Partially attributed to seasonality and of course increasing market competition, especially with the entry of more ride-hailing players in Singapore. So in fact, if you look at ComfortDelGro's taxi fleet size, it has been shrinking over the years to more than 8,000, even though it has onboarded about 6,005 or so private hire drivers to its Zig platform. So this competition remains open for sure. And to be honest, if I'm a driver, I will probably jump to whichever platform could offer me the most incentives. It's hard for drivers to be sticky on any platform really. So we shall watch this space. Okay,
and staying in Singapore, David, let's talk about SingPost, because shares of SingPost plunged nearly 12% this morning. In fact, I was looking at the closing numbers. It closed down 11.8%. Now, the firm reported second half earnings for FY 2024-2025. And even though SingPost declared a special dividend of 9 Singapore cents per share following the sale of its Australian business, if we look at its underlying net loss, it reported 461,000 Sing dollars of net loss versus net profit of 28.1 million Sing dollars seen in the year ago period. What do you make of the share price movements today then, and of course investor sentiments towards the postal service provider?
I think the previous share price gains on this stock happened because on one hand it was driven by investors who were getting very excited about the prospect of SingPost doing asset disposals and then using the proceeds to pay investors special dividends. But on the other hand, there's also this kind of investors who are keen to see whether the business fundamentals of SingPost could improve with a new set of management coming in play, or this group of investors could be happily receiving the dividends or paid to wait. In other words, I think fundamentals still matter matter to them at the end of the day. So, with the companies booking a loss and then also subsequently issue a gloomy outlook, it doesn't sit well with this group of investors. And to me, to be honest, asset disposure and special dividends could only take the stock so far.
Yeah.
So, when we read these statements, we're also getting worried because SingPost actually they expected persistent challenges to linger, with trade tensions affecting their cross-border logistic volumes. And if anything, these conditions could possibly worsen in the second half. And the worst thing is that it's expected to continue into the next financial year. So this could be weighing on the stock in the near to medium term going forward.
And if you're just tuning in, we're now in conversation with David Chow, director at Azure Capital. David, further away, let's talk about coffee at this time of the day, because Starbucks has reportedly contacted PE firms, private equity firms, tech companies and others as it sort of considers options for its China business, including a possible stake sale. Now, sources familiar with the matter said a transaction could value the assets at several billion USD. I recall some time back, was it us, who were talking about how fast food chains usually divest their China businesses to players who can better cater to local needs like PE firms. How far would a divestment in the China business be beneficial to Starbucks? And can we expect more of those, the localized menu like Dongpo meat coffee going forward?
Okay, Dongpo meat sounds a bit unhealthy and a bit exotic for me. Okay. Right. Starbucks has certainly invested heavily to strengthen its presence in China for a good number of years, but that's proven challenging in recent years. And China is Starbucks, really one of Starbucks' largest markets outside of the US. I think with over 7,000 stores, and it's about 9% or 9 to 10% of its total sales. And in the past, management from Starbucks has always say they are exploring ways to rejuvenate growth, and has noted on several occasions that they are even considering a strategic partnership to help the company better compete in China. But I guess with this latest statement, they could be throwing in the towels if no suitable PE firm is found, and then. Although Starbucks have been growing its store count in the country, a generally weaker consumer sentiment certainly didn't help, coupled with fierce competition from local rivals such as Luckin Coffee, as we know. So if Starbucks were to sell some of its stake in China eventually, and hopefully it wouldn't be the first. So I think in 2016, we have talked about that, KFC parent, the Yum Brands actually sold a stake, and then they eventually, I think, led to a spin-off and a separate listing on the New York Stock Exchange under the name of Yum China. I think the following year, 2007, I think McDonald's also sold a majority stake in its China and Hong Kong operators to a group of investors. I think, but the later is that, if I remember correctly, is that the company has since brought back some of those stakes they sold in 2023. So I think from a resources focused perspective, rebooting China might not be Starbucks' top priority right now. The company, I think, is facing bigger challenges in its domestic market in North America, which actually accounted for 75%. So with this, I feel that they will be working doubly hard to find a PE firm to take over. And with this news, I think as with a few occasions past year when Starbucks actually they told the media that they are looking to form strategic partnership, as I said, the stock usually jump a few percentage when they talk about this. So with this latest move, we could be seeing a similar move for Starbucks later tonight.
Okay, now meanwhile, David, let's talk about AI, because Nvidia-backed CoreWeave, it is looking to spend 20 to 23 billion US dollars this year on AI infrastructure and data center capacity. How would you read into that heavy spending plan?
Right. I think with this announcement of CapEx spending, I think if I remember correctly, I think CoreWeave, I think first quarter earnings were hit because they actually pushed for plans to do more AI related spendings. So you can say that they are determined to get this done at the expense of their earnings in the first Q, at least in the first Q. So with that, I think when I look at these latest round of earnings, along with what the largest technology companies, other technology companies players have said about the AI spending, I think I see a continual investment in this space. You see the likes of Meta raising its forecast for CapEx this year, and also Microsoft said that growth in such areas would actually slow somewhat next year and this year, but it will still rise nonetheless. So with that, I would say the trend is still on, and then we have to see whether these players are able to convert their CapEx whether they are able to monetize the spending that they have made in this area. And if we go back to CoreWeave, I think we can see that in our forecast, we see that you could actually post about, I think, a 4.5 to 5 billion in sales this year, or currently about 9% above consensus. And according to our analysis, as we have ascertained, AI infrastructure remains strong. So that, and then the company itself also have new contracts coming in, growing backlogs, and these are some catalysts for them in the coming years.
And finally, before I let you go, David, we have Walmart and Applied Materials reporting. Walmart, I think tonight, Applied Materials maybe overnight. What are you expecting for both companies, and what clues can we then get on? In the case of Walmart, U.S. consumption, and in the case of Applied Materials, the outlook for the chip sector amid that recent positivity surrounding AI chip makers and the big deals the likes of Nvidia and AMD might have with Saudi Arabia.
You're right. I think for Walmart, for this upcoming earnings, we are actually expecting a revenue of about 164 billion and a net profit of about 4.7 billion, which works up to about, I think, 3%, just a mere 3% net profit margin. And for Applied Materials, we are expecting a revenue of about 7 billion and a net profit of 1.8 billion. So on U.S. consumptions, I think Walmart's commentary on consumer spending and tariff previously will be that it is really looking to maintain a price advantage against competitors and actually picking up market share amid deteriorating consumer sentiment. So if there's any one company which could actually increase our market share in these times of volatility, I guess Walmart will be one of them. And I think Walmart is following their upcoming earnings release. Investors will be also looking forward to see how it's working to reduce its exposure in China, and because I think just to assess whether there's any direct tariff impact yet on the retail sectors, even though supply chain disruption and inventory risk are expected for later in the year. And I think investors will also do well to assess the Walmart's relationship with suppliers, pricing capabilities, and automations are some of the forces that will help it manage tariffs. And on Applied Material, again, the largest chip equipment maker in the world, which counts Intel and TSMC among its customers. Apart from hoping that management could actually comment on the possible, U.S. chip sales to Saudis, how it will benefit them. I think another area of concern will be, of course, China, because the country is the largest market, for spending on semicon equipment. So investors should be looking for any clarity on how the trade wars has affected demand and the potential for any additional export restrictions on equipment.
I see, lots to watch indeed. Thanks so much for the insights, David. That was David Chow, Director at Azure Capital. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.